All right. Now, as I mentioned, we had a question come through via email. Hedging a short stock position. Eileen has an issue. She ended up being assigned, and now she's short shares of Microsoft at the 210 strike. Microsoft is now trading around 220, so since she is short the stock, she's down about $10 of unrealized loss. Eileen wants to know, what kind of cover trade can you put on? Can you use a put, for example? And if so, do we buy the put or sell it in order to try and recoup some of the loss from the assignment? It'll take a long time to recover the loss if we just wait for the stock to drop in value. That's true, especially in the situations that we're going into right now. Do we use puts to cover when we are short stock? Essentially, that is the question. Well, if we're long stock, there are three hedges one might consider to do. The easiest, of course, is the covered call. I own stock, we sell a call against it, we get some premium when we enter a contract to potentially give up our shares of stock at that strike price. The premium we collect gives us some downside protection or helps us make back some of the loss on the position that's unrealized. It still takes on risk if the stock falls, and it caps the gain to the upside. Buying a put on a long stock would create your married put position. We purchase a put option to protect against extreme losses. This will increase the cost basis of the position and increase the break even at the put expiration, but we can guarantee a low risk position. Even in the case of an overnight drop of 30% where a stop order will not help you, the married put will guarantee that you're not losing more than 4, 5, or 6% on the position. We leave the upside open. Combining the two in a sense, we create a standard collar spread. I own the stock, I sell an at or out of the money call, maybe 1 or 2 months out, and then I buy a put option for a lower premium. So I still take in a positive net credit, still lower the cost basis, still have a low risk and control, but yes, still have a capped gain. Why are we going through this? Because the same is true on the other end. If we're short the stock, we just reverse the ideas. So Eileen, what do you do with a put position if you want to hedge your short stock? If you sell an at or out of the money put, you're going to create what's called a covered put position, the flip side of the covered call. You generate premium for upside protection. What do I mean by that? Well, if I collect $6 or $7 in premium for the put, well, that means that I've hedged the potential loss to $6 or $7 if the stock moves up against my position. Now, it still takes on risk. It hasn't addressed the risk if the stock really takes off, and it caps the gain to the downside if the stock really falls in the direction that you want. But it generates a premium to help the hedge, like a covered call does in that case as well. A married call position. You wouldn't buy a put to protect the short position. You would buy a call option. The reverse of the married put in a sense. What this does is it protects the upside against further losses. As the stock continues to move up, your call is gaining in value to hedge the loss you're taking on the short stock position. It takes away from the short stock position that you gained, guarantees a low risk to the upside, and of course, the downside is still open if the stock continues to fall. Now, in a sense here, what's difficult, and we're going to get to that in a minute as well, is that we already have an unrealized loss of $10. So that we have to factor in. It would be factored in to our equations in that case. So my risk might be higher because I'm going to take the standard risk for buying a call to hedge the short stock position, and it's factoring in the 10 points I'm already down. And of course, combining the two, you end up in a short collar. You get a positive premium in from the short put that you sold against the short stock. You buy a call option out of the money at a higher price and still try to keep the premium. Again, you end up with a capped profit in one direction and a limited risk in the other as well. So we still have guaranteed low risk potentially, depending on how far the stock has moved against us. And at the same time, we cap the gain as well. But those are some hedges on the position. So here's our short stock position roughly at 210. And as you can see with Microsoft already at 220.62, this is around 3:30 this afternoon, excuse me, as a 220.62, I think. So we're down about 10 points roughly. which hedge works best? Generating premium with the covered put idea, selling a put to generate premium, doing the married call, or that short collar position with the low risk to the upside and maybe a small gain to the downside. Well, which hedge works best? Well, that comes down to what we call the SIGA model. This is a term we commonly use in the blueprint to discuss the radioactive trading techniques and picking which income method of the 12 I would use, but it really applies to any decision-making process in investing. Long stock, short stock, credit spread, debit spread, management techniques, everything. The SIGA model, what are the current conditions? I'm short a stock position with an unrealized 10-point loss, and we're in the market condition of EAP. What do I mean by that? We've got earnings. The election, a question, of course, came in about that as we were expecting, and we're still in a pandemic, and things are starting to turn to the idea, at least in Europe right now, of going back to more lockdowns and stringent things as well. That's naturally going to affect global markets, the US market, and everything else. Okay, so that's the C. What are the current conditions? We know where we are. We've got a lot of known events coming up with unknown outcomes. A lot of volatility to expect in the next few weeks. A lot of movement in either direction as well. Now, what are our expectations? Now, this comes down to you, Eileen. I don't know this. If you're bullish, meaning you think Microsoft is going to continue to go up, you think, well, I think I have it on the next slide, but I'll just mention it here. Earnings, I think, are coming up on 10/27 or 10/29, a few days before the election. So you have two events back to back that are going to cause this stock to swing wildly up or swing wildly down or show no movement and decrease volatility. It's very difficult to gauge. So we're going to show you a couple other things, but if you're bullish, you might just want to consider getting out. If you think Microsoft's going to have a strong earnings and potentially bounce up 5 or 10%, even with some of these hedges in place, you're still taking a loss. Maybe it might be best to get out of it now before taking on extra loss in that situation. Is the results of the election going to cause the market to fall, cause the market to go up? Well, we just have to wait and see, don't we? We don't know. Is it already priced in? We don't know that either based on the outcome. If you're bearish, yes, staying in the position, using one of these potential structures either to limit risk, generate premium as a hedge, or combining both in the short collar might get you into the position that you want. We're going to talk about the unknown in a little bit too. So what are the current conditions? What are my expectations? It's up to you, Eileen. What are the goals? Well, it's to profit, of course, to avoid the loss, but also to protect against further losses from the unexpected, which we know we have two known events coming up with unknown outcomes. That's a difficult one. What's the A? We got the C here. We've got conditions, expectations, goals. What's the A? The A is the action. The answer to these three questions will give you an action to go forward with which structure best suits your goals and your needs. Are there more elaborate things that you can do? Well, of course, options give us options in this case. And what do I mean by that? There are other structures that you could create based on the unknown coming up, the unknown events, the known events with the unknown outcomes. And what am I referring to? Well, sometimes when I'm in a long stock position, I may buy a put to create that married put. I do that often, as many of you know. But if I feel the stock's going to drop from an unexpected event or an unexpected outcome of a known event, I might buy an extra put to create a synthetic straddle, where if the stock falls, yes, I'm losing on the stock, but I had one put limited risk already. The second put is allowed to gain in value. So I create this synthetic straddle position. Now, it's possible that you might be able to look out to December or November, buy two calls to create that synthetic straddle position where you could potentially have a gain if the stock falls or if the stock rises. But in this current market condition, with those two big known events coming up with the unknown outcome, volatility is extraordinarily high. So this is going to be expensive. We're going to see this in the graphs, but what this is essentially buying two December 230 strike calls, I believe, for about $8 a piece. $1,600 for the two contract entry against 100 shares of short stock. Pretty expensive. And if the stock stays right around 230 in this realm, we're looking at, I think it was a $3,300 loss or 18% on the position. Can you make a profit if it moves down? Yes, but this is about at 198, and this profit line you see is about at 265, 270. So still needs a significant move because the costs are pretty high in that synthetic straddle due to the volatility of these events coming up. But it is another idea. You could probably use cheaper options, maybe closer in time to November, but still after the election, to use that synthetic straddle setup. But they're going to be expensive as well because they also have the volatility priced in for the earnings and for the next event coming up as well, the election. Tried to create a couple examples. I didn't spend time too much on it, Eileen, but I tried to create an example of sort of this ratio backspread, a synthetic ratio backspread, where typically if I can get a credit by buying 2 puts and selling 1, or buying 2 calls and selling 1, I still might have infinite upside profit, but I might still have a small profit to the downside with what we call sometimes the valley of death in the middle here. I tried a few combinations that weren't too outlandish by going too far out of the money with the sell of the puts, or selling and at the money but not buying too far in or too far out of the money with the calls to create the ratio. Didn't get a good credit. So I don't think this position matches. If you're bullish, well, I would assume just get out of the short position now, buy some calls maybe, and let the bullish run ride if that's your outcome. I don't think this is a good structure, but I included it because sometimes this might work for you. Another example, you've heard me talk before about the stock repair and the stock repair tool and power options, where we do a ratio call spread to help us get back to break even faster on a long stock that's fallen against us. Well, in a sense, we could call this a short stock that has moved up against us, so we could do a negative stock repair by selling 2 puts and buying 1. The benefit here is that the break even is going to drop down to about 219. Okay, so later in the day, I'm sorry, it was at 221.10. It did move up as I was doing these slides. But we moved the break even to where we can potentially be profitable here instead of at an 8 or 9 point loss. And if the stock falls, well, we sort of cap a gain as well. What does this negative stock repair, the inverse stock repair, not do for us? Does not address the concerned risk of further upside if the earnings results coming up on the 27th or 29th are extraordinarily high and we see a 5, 10, maybe 12% movement in the stock. You'd still be on the hook for that loss in that position. Or if after the results from the election on November 4th, 5th, 6th, or 7th, or a week later, the stock starts to climb back up and Microsoft is up another 10, 12, 15 points, the negative stock repair, the short stock repair, does not address that situation. Well, that being said, I showed you some of the structures. Let's look at some of the quick examples that we have in the Power Options portfolio tools. We're going to navigate over there right now, and then I'll take the 2 or 3 questions and all the others that are coming in as well. I think I saw 2 questions already in that case. All right, so let's switch screens, ladies and gentlemen. Perfect. All right, so here we are at Power Options. What you're looking at, of course, is the standard 14-day free trial. For those of you on your trial right now, I encourage you to take advantage of the 4 steps here. Go through the quick start guide. Take a look at the flash tutorials, a few free webinars there as well, and of course, the free coaching session and all the webinars available that are in the free webinars link for further education, tools, and more. Tools, strategies, and more. Right now, I want to navigate over to the portfolio tool. And here we have our Microsoft short hedge position. We've got the married call position, went out to December for a cost of 818. This is actually the straddle, okay? That straddle I mentioned for the trying to go in both events. We'll take a look at that in a moment. Let's just start with the basic covered put. Eileen was leaning towards this. Now, why am I going out to December with all of this different information coming up? Why am I showing a December 220 put that gives me a very small profit of only 0.9%? Because of Eileen's situation. Remember, she's short at 210. The stock, okay, came back down. It's at 219 at the close, 219.66. So the prices are going to be different. What do I need to make up in this case, time value wise? Not intrinsic, but time value wise. I need to make up this 10 points that we're down, 966. So when I looked at the different options coming up, well, before or just after the earnings, excuse me, even at the in the money strikes, 225 at 770 to 820. Well, that's also about 3 points in the money. So that's only a time premium of $4. You're still down 6. Okay, this wouldn't be a good play. And you don't want to do it here because you're only getting $2 or $3 of time premium back at these deeper in the money strikes. You need to make up 10. That value that we started off with that we're already down. Even going beyond the earnings and beyond the election, where volatility where it is, we're in the same boat. We don't see any premiums at that $10 or $11 rate until we're already 5, 6 points in the money. That's not going to cut it. That's not going to make back what I need. And if the stock is below these put strike prices I'm looking at, the in the money puts, what happens? Well, we're forced to buy shares of stock, which effectually, closes the long. Closes the short stock we have, right? So we have to buy stock because of the short put obligation, which cancels out our short stock position. We get assigned we're out of the trade. But here you'd still be at $5, $6 loss on the position because you're 7 points in the money. Your time value that you're getting back is only $4 or $5. Still have that $10 we've got to accumulate for. So all that being said, that's why I rolled out to December. And you see here that 215 puts right at 1035. So just about would make it up with that out of the money. And if it fell, you'd get that at 5 extra points. That'd be really good. But the 220, which is only 1 point or so in the money right now, actually it's only about 34 cents, is priced around 13. So that gives you the 10 back, $3 a time premium, and an extra 34 cents. Not a great profit, and you need the stock to be trading below 220 at December expiration to get to that, but it's no longer a 10-point loss now, is it? Okay. If you wanted to see a higher return, you could, but what are you going to have to do? You're going to have to go out to January, February, March to find those $10 premiums, those $10 time values, Eileen, to counter the loss that you've taken right now, just to get back to a break even and a profit if Microsoft falls. Related to the question that's coming up soon in our next segment, the first live question that was asked, I believe, is, well, what kind of strategies do you expect to do around earnings or around the election? I'm not going to get into that yet. We're going to get to that in about 5 minutes. Why I'm bringing it up is because we know, again, those events are all going to be done by here. So, Eileen, the risk that I'm telling you with this position, why I'm saying the risk out to January to try to repair it is interesting, is because why? We're probably going to be in a very different market come January, come December. We're still going to have the pandemic going on, but these two known events with unknown outcomes are going to have passed, for better or for worse, for our market positions and for our portfolio. We're going to be through it, and we still have a lot to do, but it's probably going to be a slightly different, and it could be vastly different market by December, by January. Oh, wouldn't it be great to start writing 2021 and forget about 2020, right? But in any case, a lot's going to happen between now and then. So going out that far into these February, March, and January positions, we know we might be in a completely different market. And again, what does the standard just covered put, just collecting premium to hedge to help you get back to break even, not do? It doesn't address the upside if the stock continues to move up. Okay, so that's a risk you got to keep in mind. Let's go back to the portfolio here. And let's see, which one do I want to show first? Here is the buy one, sell two puts. Oh, okay. So what I wanted to do first is here, the married call. This is that synthetic straddle that I mentioned using the December 230, so 10 points above where you are. And if the stock's trading right at 230 at December expiration, you've got an 18.8% loss. But as I mentioned, the upper and lower break evens on this one are pretty steep. But this is a reasonable structure, I feel. With an uncertain short stock position, going through these two major events coming up, your earnings and the election. But maybe we could go cheaper if we go shorter. Maybe we could go to November 6th right now. Let's just take a look. I don't know if I want to go right at the money, but we'll try it. Okay, so we'll do a 220. See, there's still $8, but at 10-point lower strike. That's pretty rough. That's going to be about the same risk. It might even be more. Let's take a look. So it's not necessarily cheaper, because of the volatility, this expiration cycle, November 6th, is going to be most impacted by the election and by your earnings. And it would help if I try that again. That didn't come out the way it should. I'm sorry. Thank you. I meant to buy two November 6th 220 calls. We're doing a married call here, Mike, just slightly out of the money in that case. All right. So that's $7.35. It is a little bit cheaper. My apologies. I looked at the puts. I'm a trained monkey. I'm so used to looking at married puts. It just went to my mind. There we go. That's better. So the risk is still 13%. Roughly. It's not 18%. It's 13%. You still got a risk of $2,500 if the stock's trading right at 220 on November 6th after the earnings. Lower break even, pretty tough, 194.75. Upper break even, 245.25. And you only have 12 days to go. I'm sorry, not 12, 21 days. Okay, but a lot could happen in those 21 days. Not a bad structure to be in, but it is costly. But with two known events coming up with unknown outcomes, expecting swings one way or the other, this might be the better structure to be in that case. Okay. So, of course, you could just do the standard married call position shorter term. That would, what did we talk about? It would hedge the loss a little bit. You have a maximum loss of only 8.7% if the stock continues to move up, a break even of 202. It doesn't get you back to break even, but it stops any further losses to only 8.7% if the stock continues to move up. And of course, this was the shorter term November 6th after the two events. We could do the short collar instead by just adding a slightly out of the money short put to help pay for that premium. Of course, I went too close to at the money, so the cost of that call is too high. But I could hedge some of it with, say, an out of the money put. This would lower my risk, but as you can see, I'm probably not going to be at a profit. Yeah, that's not what you want. So we'd have to flip this a little bit. What do I mean by flip it? I got to find a much cheaper out of the money call to do the short collar. So let's say we go right at the money with the 217.5. Okay, a little out of the money, $6. I'm probably going to go up, yeah, 232.50 or 235. That's about half the price there. So let's do that. We're going to sell the put now, opposite of what we do in a long stock. Instead of selling the call, sell the put. Buy the call instead of buying the put. Gets us net premium of around $3.60, $3.80 or so. Didn't get us to profit level. That's a shame. So we're probably going to have to use the sell the 220 put for a higher premium and buy something cheaper because you still want to be at a profit. Risk is still at 8.8%. I'm sorry, I didn't see that combination wasn't going to work off the top of my head, but that's sort of the problem with these short collars and try to play into this higher volatility. Yes, I'm getting a higher volatility for the call. I'm sorry, the put premium I'm selling, but I'm also paying higher. To find the structure I wanted with that short collar, I was actually out to December, but it was still pretty wide with about a 9% potential risk if Microsoft shoots up, with, of course, an only 2 or 3% return if it fell down below 220 or below 275. So those are some of the basic ideas I think you want to look at first. Let me just go back here one moment and go back to my screen here. There you go. So again, Eileen, the covered put, selling an at or out of the money put to generate premium, caps the upside or the downside gain, caps the max gain, gives you some hedge, but in order to already cover the $10 loss you have, you're going out to December or January. And we talked about the warning of how different a market this is going to be at that time, likely. It could be the same, but likely we're going to be looking at a different type of market. And at the same time, you've got two strong events coming up that could cause this stock to potentially swing up wildly. And the covered put does not address that loss to the upside. Buying a call, the married call, will cap those losses, but it'll already incorporate in the $10 unrealized loss that you have, plus any time value cost of the call. But if there's a wild swing, at least you know you have a capped, limited risk to that upside. And you still have left the downside open if Microsoft does fall because of those earnings. And then we talked about combining the two for the short collar spread. And at the same time, some other more elaborate ideas we had mentioned, of course, going with that potential buying two calls. There we go. Sorry, we're going to flop right over there again. Buying 2 calls to create that sort of synthetic straddle position, carrying a high amount of monetary risk on the position as well, but in a structure that may be able to take advantage of wild swings with the known events coming up that have unknown outcomes and are going to happen within 5 or 6 days of one another. So that is my discussion, pretty much just about a half hour even, minus my 5-minute open, so about 25 minutes there on hedging short stock positions. The reverse stock repair, we saw that briefly too. That's more for if you're still bearish on the position. If you think that the stock has the potential to be bullish or there's an event that might cause the stock to move up, that short stock repair using the ratio put spread won't get you back to break even unless the stock falls slightly. It doesn't address the risk to the upside that you still might take if there's a large gap up